All three major indexes are down today. The NASDAQ is down about 1.5%. The S&P 500 is down about 0.5%. And the Dow Jones is down 0.13%. My 2032 portfolio that I'm building publicly here on YouTube and in my newsletter is down more than 3% today. And I've been investing for a while, and I could just hear the headlines and see the headlines now on CNBC. Markets are in turmoil. I can hear Jim Cramer in the back of my head yelling, sell, 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 and whatever strategy he's changed to on a day-to-day basis. And so what that does, and seeing all those headlines, is it just makes everyday investors like you and me doubt what we're doing, doubt ourselves, wonder if we should even be investing in the market, and if it's just not worth our time and the stress. What I'm trying to do is show a way that we can invest with a strategy of building this portfolio in 10 years, over 10 years, and contributing money consistently and buying into great businesses and becoming part owners, to where investing doesn't have to be this stress-inducing activity. I want investing to complement my life and my goals, not consume my life and my goals. And so that's what I'm going to talk about today, is how I'm thinking about this in relation to this portfolio that I'm building here publicly over the next 10 years, and why I'm not worried about the market being down today, tomorrow, next week, or next month. And in fact, building a long-term portfolio like that, that's actually what I want to happen. Is I want the market to be down over the short term so that I can keep buying more shares of these great businesses. And eventually, when things turn around, which they always have, and likely that will continue, and great businesses will continue to win over the long term. So let's jump into it. Let's start by transparently showing the 2032 portfolio. And reminder, my goal is to grow it from $10,000 to $1 million over 10 years, from 2022 to 2032. Not just through appreciation, but also through contribution, which is an important part of building a portfolio that people don't like to talk about. The more we can save and invest, the more we can live below our means, the better opportunity we have to grow a large, life-changing size portfolio. So that's part of what I'm trying to show through this portfolio. So current value, $20,000, $20,244. This is just one day. We're down about $800, which is 3.6%. And so lesson number one is perspective, right? And this portfolio has only been open since February 15th. But even in that time, perspective. And so if we zoom out to February 15th, when we put in $10,000, and in total here, you can see the net cash flow is $19,000. So I've put in $19,000 total. The gain is $1,361 for a total return of 10.17%. So even if we just zoom out a month or 2 months, we get enough perspective to show, hey, these day-to-day drops and gains really aren't what we should be paying attention to. And honestly, a month or 2 months is way too short as well. We want to get to the point where we're looking at years, right? And I say that because it looks kind of crazy, but this is a chart of the S&P 500 since 1950. And what this is showing is the percent off all-time high. And what I want to show is that big drops in the stock market are totally normal, and it's part of what naturally happens in the stock market. We're not even in a big drop right now, but I just want to show that these big drops happen. And even when they do happen, and as they do happen over time, you can still build very impactful wealth in the stock market. And so what we're looking at here, this line is every time the S&P 500 has been 20% or more below its high. And so if we count, there's 1, 2, 3, 4, 5, 6, 7, 8, 9. We'll count that one. 10, 11, 12 or 13. We'll call it 12 times since 1950 that the S&P 500 has been down more than 20%. That's on average once every, what, 4 or 5 years that's happened if we divide that out. And if we go even more extreme, this line right here is down 40%. 1, 2, 3 times the S&P has been down more than 40% since 1950. And so what does that look like if somebody had just put $10,000 into the S&P 500 in 1950? What would that look like today with all of those big crazy drops? Well, that $10,000, if it was just left alone, would be worth $2.73 million, even with all of those big, scary 20% to 40% drops. So we're not in a situation like this right now. We will be again in the future, but the key is to know a little bit about this history and to not get scared out of investing forever when the market is at its worst point, and when historically we should have been trying to either buy as many shares as possible of an index, which indexing is a great way to go. And I invest in individual stocks, but just owning an S&P 500 index or even a dividend growth index like SCHD, do your own research. Obviously, those are great options for people that don't have the time or interest to invest in individual stocks. So anyways, that's a little bit of perspective on the market. And so we've got the market perspective, but the other thing we have to think about is our own situation and what we're doing with these portfolios. And I outlined it here. I started this portfolio in February of 2022. As of Friday of last week, I will have contributed $17,500 of $370,000 total that I'm going to put into the portfolio over the next 10 years. How do I get that math? I plan, if things work out, to do $3,000 a month over the next 10 years. So 3,000 times 12 is $36,000 a year, times 10 is 10 years is 360,000. And I started the portfolio with $10,000. And so that's $370,000 of total contributions. And so far I've put 17,500 in. And so even though if a big drop happens right now in the stocks I own, it's going to be scary, it's going to stink. People are going to troll me on YouTube and on Twitter. But honestly, that's, if I'm thinking about the long term, that's what I should hope would happen, because as long as my businesses are real businesses and they're high quality and they're going to grow revenue and earnings over time, eventually that will be rewarded by the market. And so let's just look at some individual companies. And, you know, these are high flyers that a lot of people, this is Y charts. These are high flyers that a lot of people know about and they've been following for the last few years. But a lot of people might not know the history of NVIDIA, and that NVIDIA was down 80% in 2002. It was down 80% from its high again in 2008. Then it's been down 40% multiple times. And still, $10,000 invested in NVIDIA in 1999 is worth $6.43 million. Is it realistic for people to hold a stock through all of that when it's completely changed their life and it's generational wealth? Probably not. It would make sense for somebody to realize some of those gains and actually let that change their lives a little bit than growing straight up to $6 million and just thinking that it's possible they're going to keep it all there. 99% of the time, people would not do that, especially if it becomes most of their wealth. But the point is that this happens with great companies a lot. We're looking at Google now. And when it happens, if you're owning great companies, that's a time to accumulate shares. When everybody's scared, it's the old Warren Buffett line, be greedy when others are fearful and fearful when others are greedy. It's really hard to do, but it makes a lot of sense when you hear it. But me looking at these charts and the history helps me have that mindset. And I hope to maybe help other people have that mindset too. So Google, same thing, right? Down 25%. 1, 2, 3, 4, 5, 6 times, down 50% once. And that's just since 2004. And again, let's look at $10,000. It's $10,000 since 2004 has grown into $560,000. So let's take a look. Market, I don't know, looks like it's doing better, but honestly, I don't really care what's going on a day-to-day basis. That's the mistake. That's the big secret for investing, is to ignore all of this stuff. Let's just check how different buckets of the portfolios are doing, right? And we can get an idea. So these growth monsters are down 3.8% today. Dividend growers are down 0.2 or 0.02, so looking pretty stable. And then crypto, which is the new bucket I added, I talked about all this in previous videos and in my email newsletter, austin.substack.com, is down 1.63%. But if we zoom out and we look at all, growth monsters is up 17%, dividend growers are up 1.76%, and crypto is up 2.57%, which I just started those on Friday. So we talked about how much money I'm adding to the portfolio over time, right? And so let's talk a little bit about position sizing. Again, none of this is advice. I'm just sharing how I'm building this portfolio. If I know that I'm going to add over the next 12 months, my goal is to add $3,000 a month, then in my mind, even though these positions seem kind of large right now, 10.4% in GitLab, 9% in Snowflake, 9% in Monday. If I look at the dollar value and I think about how much money I'm going to add over just the next year, the max size that I really would want a single position to represent of the funds that I'm going to be adding in the next year is probably about 10%. And so if I'm going to add another $36,000 in the next year and the portfolio's already at about 20,000, that's $56,000. So that means the largest position I would want would be about $5,000 or $5,600. And so even though these are large right now for the portfolio, if I felt there was just an amazing opportunity in these stocks, I would be happy to build them up and add another, $2,000 to $3,000 to these before they start to get too large to where I would want to stop adding to them just because the position size is too large. That's my own risk tolerance. Obviously, my portfolio is volatile, and we can see that just by the portfolio being down 2.75%. So I have to be comfortable with that volatility. If I want less volatility, then I need to orient more towards these dividend growers, which are not going to grow as much in value. They're down 1.7% since February 15th, but they're also not going to drop and be nearly as volatile when things are scary because of the types of companies that they are and the history of these companies as dividend payers. Let's talk about the third thing, which is just understanding and studying the companies and the news of the companies, right? So if I just look at the percentages for today, it's pretty scary. There's red, 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 red. Well, what's changed with these companies fundamentally in a single day? And so one way that I look at the news is I try to ignore news day to day unless there's like meaningful headlines, but I study companies' quarterly earnings reports, their annual earnings reports, investor conferences, and I'll share all that stuff over this YouTube. But then if there's a kind of a crazy day or a stock is moving big, I will look to see if there's like any meaningful news headlines. And so I'll just do that with you live here and look to see if there's any real thesis changing news headlines for any of these companies that are driving them lower. My guess, because everything growth or SaaS is off pretty big today, my guess is no, there's nothing individually about any of the companies. It's just for some reason people are trading out of that stuff and whatever. And so, yeah, I mean, I'm not seeing anything. Shopify attracts a new bull. Well, that's not generally bad. Really, I don't care that much about it, but yeah, so there's no breaking news headlines for any of my individual companies that would make me think about even changing my strategy or whether or not I want to own them or not. And so that's it. That's point number 3, is to study the companies you own, know why you own them, which again, you got to do your own research, but I'm sharing that stuff publicly here and in other videos. And then the fourth thing is community. And the best place that I know of for an investing community is commonstock.com. Full disclosure, I'm an employee of Common Stock. This is Austin's opinion, not Common Stock's opinion. None of this is financial advice, but we're building a really cool platform and community for investors of all skill levels. And I'm just sharing my profile right here. Cool thing about it is people can connect their brokerages securely. And so I have mine connected. You'll see a little bit of difference in the numbers here just because it takes a while for my brokerage to update into Common Stock. But let me just show you. So The cool thing about it is I can see how my portfolio is performing. I'm not going to go 3 month, 1 year because I haven't had it that long. But if we look at 1 month, it says the portfolio is up 13.1%. And you can compare it to the NASDAQ. So beating the NASDAQ, beating the S&P 500, beating the Dow Jones, beating the Russell, and not beating Bitcoin. Bitcoin's up 20%. But I would never have all of my assets invested in Bitcoin. So I'm not really concerned that I'm underperforming Bitcoin. I think it's pretty cool that, over the short term, a month is very short term, I'm at least outperforming all of these stock indexes. That's pretty cool. We'll see how it goes over time. And I'm going to compare myself to it and see, should I just be invested in an index? Maybe. Other thing, you could see my stocks and what I own, and you can see the total return in them. And so again, even with today's move, right, like some of these are going to come down a little bit, but you could just see the type of move some of these growth and SaaS style companies have had. They're up big, and it's not realistic to expect them to just go straight up. There's going to be volatility. And over here, it's pretty cool. We just added these new portfolio statistics. You can see 54 trades per month. The reason that's so high is because I built this portfolio over the last basically 2 months. And so there's been a lot of purchases to build into all those positions. And then with M1, it's really easy to just, I had auto invest set for a while, and it would just automatically buy pretty much all of my positions each month. Average holding period is 4.6 months. Again, the portfolio has only been open for a couple months. So it says 29 open positions. The top 10 positions represent 56.9%, and it does show the best 1 year trade, which for me is Zoom. I don't even know when that was or what it was, but it's pretty cool that it's on there. And then it also gives like a sector focus. So I'm obviously heavily oriented to information technology. As the valuations and the multiples in my tech stocks come up, and as they get to be larger position sizes, then you'll see me, and I'll share it out, you'll see me scale more into dividend growth companies. The other thing you could do is you could see trades on here, right? And so you can see that I think it was on Friday, I opened the new position in GBTC, tells you the price, bought more Mercado Libre, bought more Snowflake, bought into the Grayscale Ethereum Trust, and Advanced Auto Parts. So that's all the stuff I said I was going to do in my previous video. And then before that, you just see a bunch of buys, right? So I'm building this portfolio over time and buying into these positions. Really have no intent to sell things right now. I think that's it for today. The big lessons that I just wanted to share, or thoughts that I wanted to share, is the market's down today. I don't know what's going to happen for the rest of the day, for next week, next month, or next year. For all I know, the market could be down 20%. But if I think about my long-term perspective, and then I'm adding $3,000 a month, $360,000 over the next 10 years, then my mindset needs to be, I would actually prefer stocks are flat or down over the next 8 years. And then the last 2 years before this time frame of this portfolio ends, I would just want them to rocket. That's not how things work generally. Generally, there's just ups and downs and a lot of in-betweens. And so it can be exhausting, especially if you're focused on the day-to-day latest stock tips. And that's really popular stuff, but that's not what I want to share on YouTube. And that's not how I've grown up investing. And that's not what's helped me be successful. And so I'm just trying to share, different thoughts and ideas on what's helped me kind of like demystify the world of investing for somebody who don't have a background in finance. I was in the military. I have a degree in criminal justice. I learned all of this stuff on my own, and I'm just trying to share information that help other people that are in the same boat realize that it's not too complicated and too scary for them. And again, I do individual stocks, but this is M1. And so if I wanted to go to research and I wanted to find funds, you can see some great mutual funds that you can own here with very, very low expense ratios. And these aren't recommendations, but generally index funds are a great option for investors. And you can see the expense ratio. You can see some of them that pay a dividend yield and the pricing history. This right here is showing its average return over the last 5 years. And so we can see, again, just over 5 years, all the scary headlines, COVID, this unfortunate crisis in Ukraine, and every other scare that we've had, inflation, rates, all that stuff, all of these major indexes are doing just fine. The people that aren't doing fine are the ones that are trying to trade in and out or chase the crazy hottest stock, which is not what I'm trying to do. So a couple of my favorite indexes real quick is, again, Vanguard S&P 500 ETF, great for somebody that wants exposure to the market. The Invesco QQQ Trust is great for somebody that wants technology exposure to some of the biggest technology companies, the Googles, the NVIDIAs of the world. And then for somebody that wants dividend growth is SCHD. And so even though it's a dividend growth portfolio, over the last 5 years, it's still up 78% and it's yielding 2.82%, which is pretty awesome. And so that's it for today. Hope you enjoyed the video. If you enjoy it, like and subscribe.